Hey everybody, Dave Lewis here with High Impact CPA. We're here to help you make a real impact on your business by replacing your internal finance function, develop proactive tax strategies, and implement systems and processes that will help you reach your goals, save time, and maximize your cash flows. It's Q&A Wednesday where I like to go over common questions I get from prospects and clients that I see around the interwebs. Today is really aimed at kind of the startups and the businesses in their first year, and it's a question that I see all the time in various forms or another. It's usually framed as should I be taxed as an LLC, which shows that there's typically some confusion around the difference between a legal entity and a tax structure. So I thought I would just quickly break down the basics for you. So for this question, we have two different subjects to go over. The first is the notion that your limited liability company or LLC is the same as your tax structure. Your LLC is actually the legal structure for your business, so you'll file that with your Secretary of State to create an entity separate from you as the business owner. The purpose of that being to protect your personal assets should liabilities arise in your business. So someone falls in your business and they sue the business, you don't want them coming after your personal assets. So that's kind of the purpose, is creating that corporate veil. So I will say it's important. Make sure you engage an attorney to make sure you're set up properly. So making sure you have solid articles of incorporation, you have a strong operating agreement, partnership agreement, what have you. Now, on the other side of this, you have your tax structure. As an LLC, you get to choose or elect the type of tax structure that you want. Single member LLCs will default to a sole proprietorship. That means the IRS basically treats you and your business as the same thing for federal tax purposes. So you don't have to file a separate business tax return. You just file a Schedule C, file it with your personal return. Now, LLCs with more than one member, they'll default to a partnership structure, meaning you'll have a separate partnership tax return. You'll get a Form K-1 at the end of the year, which will then flow down into your personal tax return. You can also elect to be taxed as an S corp if you meet certain requirements under the tax code. It's a really popular structure for saving on self-employment taxes, but again, there's some criteria there that you have to meet. Most small businesses will. Again, that's another pass-through type entity where you'll have a separate corporate tax return, and then the income from that will flow down into your personal tax return. And I mean, you can even elect to be taxed as a corporation or more commonly known as a C Corp. So this is a separate taxed entity all on its own. You'll actually pay tax at the corporate level, and then you as an owner will pay tax again and in the form of dividends when you pay yourself out of that C Corp. There's some other things with officer salary and stuff that's beyond the scope of this video. The point is there's a lot of flexibility in how you're able to have your business be taxed from the federal perspective. There's also hybrid or layered structures, again, beyond the scope of this. But so the question that always comes at the end is, well, what's the right structure for me? And the answer is, of course, a frustrating, it depends. So it really depends on your unique situation, what your goals are. Are you going to be raising a ton of capital from a ton of different people? The level of flexibility you have in your distributions from the business. It depends. So if you need help understanding which tax structure is best for you, feel free to reach out to me anytime using the contact information below. And hopefully this has clarified a few things for you at the basic level. And again, if you have any questions, reach out, and happy Wednesday to all of you.